Now, from the sidelines of the BofA Securities 2025 India Conference, my colleague Nimesh caught up with Anand Swaminathan. He's senior analyst, India and ASEAN banks at BofA Securities. He began by asking Anand why BofA is positive on mid-sized private banks and their view on PSU banks as well. Listen in.
We are broadly positive on the sector where we are right now. We are at an interesting juncture for the overall sector as well. We are at the start of a very good easing cycle from the regulator. We are at the turn of a growth cycle as well. And we are in the middle of a lot of geopolitics and a lot of tensions there as well. But what we see in India is where investor positioning is, where valuations are for the Indian banks. We do think the risk reward for the overall sector still remains pretty good. We see selective pockets of value across the spectrum, across big cap banks, mid cap banks, and the government banks as well. And especially in a rate cut cycle, we started liking a bit more of the mid cap banks, which benefit more in a rate cut cycle.
Sure. I actually wanted to ask you on that. So we have a policy coming up. There is a lot of hope of maybe it'll surprise with a 50 basis point rate cut. But in general, in a cutting rate cycle, you spoke about smaller banks benefiting most. But what's your broad thesis on whether the small banks do well or the PSUs bank do well?
Sure. I think, Nimesh, the overall question is eventually, do we get better growth or not?
Yeah.
At the outset, lower rates do kind of hit bank margins to begin with. But eventually, you will see the mid-cap banks who are structured more like NBFCs in terms of asset and liability, eventually benefiting in terms of NIMs. And that is what is driving our benefit or preference for the mid-cap banks in the next 6 to 12-month period. But overall, with all these efforts and better liquidity from RBI, we need to see that translate into better macro growth, better credit growth. That will eventually drive the stocks and performance in our view.
I'll ask you about the credit growth and the asset quality as well. But first, a word on the PSU bank stocks. We've seen a bit of recovery in the PSU banks as well. And as you've been writing of late, there are a lot of others who've highlighted that the performance of PSU banks have been pretty good. And that's why you're seeing a bit of bridge getting, bridged. The gap is getting bridged with the valuations on PSU banks. What's your take on PSU banks? And are you all bullish on that?
Yeah. We've been positive on PSU banks for more than 2 years now, Nimesh. We see two things. One, from a structural, how they are operating, risk management, what they focus on. There is a meaningful change in how these banks operate. And that takes time to show up in numbers. Number two, in terms of their own intent to grow and defend their market share, we are clearly seeing that in numbers. And the loss in market share is significantly narrowed. That is also showing up in numbers. I think in the short term, what has driven that kind of move in the last month or so is a very low investor positioning and where valuations are. And if you see the valuation gap between the private banks and government banks, which had again widened meaningfully to historic highs. I think that is what partly is driving this short-term rally in these names.
Sure. But, if I want to ask you about how to value the PSU banks now. Historically, we've been taught it's easy to buy PSU banks at 0.5 time book and to sell around 1 time price to book. Yeah. Now, most of the PSU banks are trading around 0.95 to 1 time price to book. Is that going to change dramatically in terms of higher valuation for the PSU banks going forward?
Yeah. It's an interesting question, Nimesh. It depends on sustainability of how they deliver numbers. Right now, if you look at forward book numbers, they are trading at around 0.8 times and around 6 times, 7 times PE. If you compare that to private banks, they're almost twice that multiple. I think what we are going to see is next few quarters, next couple of years, as the market realizes that the asset quality improvements are real, we do think some of that kind of valuation re-rating can happen. We do think majority of the government banks can deliver around a 1 to 1.1% ROA on a sustainable basis. That would end up being a 1 to 1.2 times price to book and around 8-9 times PE. And more importantly, these banks now grow their book value at 13-14% a year, which means every year your valuations get more interesting. And that's what I think gives you better risk reward in these names even now.
You spoke briefly about asset quality, and the big question mark on asset quality has been for the MFIs. And that seems to be largely getting priced in the stock prices. But in terms of real asset quality concerns, do you think the worst is behind and from here on, you're going to see improvement in the MFI book?
Yeah, we met a lot of banks in our conference as well. I think what is clear is the worst is behind us. That's good news. What we need to see is how fast is the normalization process. The June quarter typically is a weak quarter for the macro, and seasonally not much happens. So probably the improvement in June quarter will be gradual, but we do expect from the September-December quarters things to improve meaningfully from asset quality perspective. And when that happens, we will see growth and dispersals pick up much faster as well in this segment.
The other big thing was we recently had an accident, so to speak, with IndusInd Bank, the regulator going down heavily, and then there was a large loss as well. Yeah. How should investor approach the mid-sized banks? Given that what happened to IndusInd Bank, and you are bullish on a few of those mid-cap banks as well. What should be the investor approach?
I think we need to take these cases one by one. We cannot extrapolate and make a broader sector view on that. I think what is true definitely is in the last cycle, 7-8 years, the regulatory approach and oversight has significantly improved. And with technology, a lot of things have come under control. And I would say generally also from an investor perspective, the governance perception for Indian banks has meaningfully improved. I think we should just look at this as one case and not extrapolate it to the broader sector. I think the key thing here is RBI is on the watch, and we have a overall ecosystem and governance structure which keeps things pretty much in control.
So for the second half, we want to ask you, given that there are going to be rate cuts, given that there will be some stimulus as well from what the government has announced, what are the key things to watch out for from a banking perspective, especially from a private bank perspective?
Yeah, I think what we are tracking, first of all, is the demand drivers. Right? So that's finally the most important thing to drive credit growth. Unfortunately, we are not seeing that many positive signs as of yet. It could be seasonality as well, because June quarter is seasonally weak. We would look for any signs of improvements in consumer sentiment, any signs of improvement in corporate capex sentiment. I think it's a matter of time, given the risk appetite is there from the banks to lend. And finally, liquidity was a big problem for the last couple of years. Yeah, it's getting fixed as well. So from that perspective, I think all the pieces are fitting into place. I would say it's a matter of time we start seeing growth improving.
So then, before I let you go, what would be a pecking order, say, between MFI, between small private banks and large private banks? What would be your pecking order?
As I said, we do like across the spectrum specific names, but we do think as a play on the rate cut cycle, we recently turned a bit more positive on the mid-cap names, which will eventually see benefits from rate cuts. They did see a lot of pressure on their NIMs over the last 2-3 years because of tight liquidity and all that. I think all that reversing will eventually improve, and there should also be a better beta play on the eventual macro recovery in India as well.
Well, interesting views there with regard to BofA Securities. They believe that risk reward is still favorable for a lot of the banking names.